Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Today we are doing a deep dive into something really fascinating about global energy.
Yeah, it is a really massive story that's kind of flying under the radar right now for a lot of investors.
Right, because, if you're an everyday investor right now, especially with President Trump really pushing our own domestic energy independence, drilling here in the U.S., we're naturally hyper-focused on our own production.
Exactly. We're looking at places like the Permian Basin in Texas, which makes total sense.
Yeah, we get like tunnel vision. And
Right.
when we do look overseas, we usually just stare right at the Middle East, right? Because we constantly hear about how hungry Asia is for energy to power all their manufacturing.
Oh, absolutely.
Yeah.
The assumption is always that Asia is just going to, sign another supply contract with the Middle Eastern supplier.
Right, but according to recent analysis, there's this massive plot twist happening. Asian economies are quietly spending billions to rewire their supply chains, and they aren't looking at the Middle East. They are looking right next door at Canada.
Yeah, and it's a huge rotation of capital.
Mhm.
But there is this really big geographical illusion that totally trips up investors who are trying to play this shift.
Okay, let's unpack that right away because, when people start looking at Canada as an energy exporter to Asia, the first thing they do is pull up a map and just zero in on British Columbia.
Which, I mean, logically, that makes total sense at first glance, right?
Right, because British Columbia is right there on the Pacific Ocean. So if you're sitting in a boardroom in like Tokyo or Seoul, BC offers this really quick, highly efficient 10-day shipping route across the ocean.
Exactly. From a pure shipping standpoint, the coastal ports in British Columbia just look like the most critical piece of the puzzle.
Yeah, you see these new port facilities, massive ship stocking, and it's super easy to tell yourself this great investment story about owning the coastal infrastructure.
But the data shows that focusing just on British Columbia is actually completely backwards.
Right, I love the everyday analogy for this. It's like praising the loading dock at the back of a supermarket when the real magic is actually happening at the massive factory making all the goods.
That is a perfect way to put it. A state-of-the-art loading dock is totally useless if the factory itself is empty.
Exactly. So, according to the analysis, Canada's overall energy strategy isn't really a distribution strategy focused on those ports at all, is it?
No, not at all. It is strictly an export strategy built on a massive production base.
Yeah.
And that specific base, the actual factory, is the province of Alberta.
Okay, so Alberta is the absolute core here.
Yeah, it's Canada's largest oil and gas production hub. The real value drawing all those billions of dollars from Asia isn't just the exit door in BC. It's the fact that Alberta holds this massive, reliable supply deep inland.
So, if Alberta is our giant factory, what exactly is making it run so well right now? Because I feel like I remember hearing, like, years ago that the Alberta oil sands were super expensive to run.
Oh, historically, yeah, that skepticism was totally warranted. I mean, digging heavy oil out of the sand used to require staggering upfront capital.
Right, you always picture those giant earth-moving dump trucks, right?
Exactly. Massive labor costs, huge diesel bills. It felt like this high-risk bet where you were just, crossing your fingers and praying for a lucky spike in global oil prices.
Wait, so usually in the energy market, you do need high prices to make a profit. Are you saying these companies actually changed how they do business so they can be profitable even without a lucky price spike?
Yes, exactly. The recent reports highlight a complete industry-wide makeover. These assets have totally flipped from being high-cost burdens to what analysts are now calling low-cost, long-life cash flow assets.
Wow. Okay, so how did they actually do that? I saw in the analysis it mentioned Suncor's plan for like the year 2040. They're shifting to something called in-situ extraction.
Yeah, in situ. It literally translates to in place, and it is a total departure from the giant open pit mines.
So what are they doing instead of driving those big trucks around?
Basically, instead of moving millions of tons of earth, which has massive variable costs, they just drill down and inject high-pressure steam deep underground.
Oh, wow. So they literally melt it down there.
Exactly. They melt the thick, heavy oil right where it sits, and then they simply pump the liquefied product up to the surface.
That sounds way easier. So they're essentially moving from a messy, super expensive mining operation to a much more targeted, like predictable manufacturing process.
You nailed it. And the financial impact is staggering. Suncor's management actually noted that this in-situ method generates double the cash flow per barrel compared to their legacy mining.
Wait, really? Double the cash flow per barrel without needing the actual price of oil to double?
That's the secret. They are drastically lowering their baseline costs. They aren't just passive beneficiaries of a wild commodity market anymore.
That changes everything about how you'd value a company like that.
Totally. Projects like their Firebag expansion or the Lewis project are designed specifically around this high-margin extraction.
And we saw this play out recently, right? Canadian Natural Resources had an earnings report on March 5th that just blew past expectations.
Yeah, they completely beat the street.
Uh,
And if you dig into the numbers, they didn't just get lucky with oil prices that quarter. The beat was driven by actual production expansion and incredibly strict cost control.
right. The underlying business is just running better. They are manufacturing the product cheaper and faster.
Exactly. And when a company proves it can generate that much free cash flow, regardless of minor price fluctuations, it just becomes a magnet for international capital.
Okay, but this brings us to a huge, logical hurdle. If Alberta is this highly efficient, super profitable factory making cheap energy, how are they actually getting it to the coast?
Yeah, the delivery trucks, right?
Exactly. A factory operating at peak efficiency doesn't make any money if all the delivery trucks are permanently stuck in the parking lot.
Well, the pipeline bottleneck is actually the most revealing indicator of Alberta's true value right now.
Okay, what do the numbers say about the pipelines?
The data points right at the Trans Mountain Pipeline, the TMX. Recent analysis shows that this pipeline is already operating at near maximum capacity.
Wait, didn't that just get finished? It's like a city building a massive new 6-lane highway. And on day one, it's already packed with bumper-to-bumper traffic.
Exactly. And the story there isn't the physical highway itself. It's the fact that everyone is so desperate to travel.
Right. The demand is just overwhelming.
Yeah, the fact that the TMX filled up so fast fundamentally proves there's a massive immediate appetite to push that product west to the BC coast and out to Asia.
So if the current infrastructure is maxed out, people are going to want to build more, right?
Oh, absolutely. The data shows Alberta is already reviewing the possibility of a brand new pipeline that could move 1 million barrels a day to the northwest coast of BC.
1 million barrels a day, that is huge. And who is actually putting up the money for that?
That's the crazy part. Middle Eastern and Asian capital is already closely eyeing this project.
Wow. If Middle Eastern capital is looking to invest in Canadian pipelines, that tells you something. They are effectively hedging against their own region's volatility.
They recognize where the reliable long-term supply is physically located. But it's not just a crude oil story either. This geographical advantage is dictating natural gas investments too.
Right. Let's talk about the gas side, because the analysis points to liquefied natural gas, or LNG. Specifically, this massive facility called LNG Canada.
Yeah, their Phase 2 expansion is looking highly probable right now, especially after the geopolitical panic triggered by the March 2026 Middle East war.
Which makes sense. Whenever there's a supply shock, major economies panic about volatile regions. So a stable source of LNG in Canada suddenly commands a huge premium.
Exactly. And because of that anxiety, TC Energy is looking at expanding the Coastal GasLink pipeline, which feeds raw gas to these coastal facilities.
But again, the real competitive edge for a project like LNG Canada isn't just that they have a fancy export terminal at the port in Kitimat, right?
No, it goes right back to your factory analogy. You can build the most beautiful, high-tech export terminal in the world, but if the raw material arriving at the back door is too expensive, you can't sell it globally.
Right, so the terminal is just a processing point. What makes it profitable?
The secret is the incredibly cheap, abundant feed gas flowing in from Alberta and the Montney region.
Okay, so feed gas is just the raw natural gas extracted straight from the ground, right?
Yes, and Alberta's legacy pipelines and staggering underground resources are perfectly aligned to provide this input at a fraction of the cost of other regions.
So these pipeline bottlenecks are actually a good problem to have. They're proof of this highly profitable supply.
Exactly.
So if all this cheap energy is rushing to the Pacific, who exactly is standing on the other side of the ocean with their wallet open?
Well, the data gives us a very specific geopolitical trigger to look at. Let's use South Korea as the main example for Asia's long-term playbook.
Okay, what did South Korea do?
In April 2026, the South Korean government urged the passage of a $17 billion supplementary budget.
Wait, $17 billion? That's not just a minor tweak. That's like a massive national infrastructure bill.
Exactly. The explicit goal was to respond to the Middle East energy crisis and permanently stabilize their supply chains.
Because I mean, South Korea is a highly advanced manufacturing heavy economy.
Hmm.
They make cars, semiconductors. They literally cannot afford to have rolling blackouts just because a conflict started halfway across the world.
Right. When a country drops $17 billion to fix a supply chain, they aren't day trading. They aren't looking for a quick fix for a bad quarter.
It sounds like they are signing up for a premium long-term subscription service because they know the company isn't going out of business.
That is exactly what they're doing. And the recent analysis shows they are choosing Canada specifically because Alberta offers something incredibly rare.
Like what? What's the specific draw?
They want the massive upstream bases, the long-life assets, the low-cost in-situ production, and the expandable pipelines. Canada is stepping up as a permanent security partner to reduce reliance on the Middle East.
So they aren't just picking Canada because it's like a polite, stable democracy. It's based on the hard math of Alberta's profitability.
Completely based on the math. It's a structural shift intended to last for decades.
Okay, but I have to play devil's advocate here. If Canada is this undisputed energy powerhouse, why isn't Wall Street dumping every single dollar into Canadian energy right now for immediate returns?
Because there is a very real limiting factor, and this is a crucial reality check for anyone listening.
Okay, what's the catch?
The data explicitly warns against over-optimism in the short term. You have to understand that Canada is a long-term alternative, not what the industry calls a short-term swing producer.
A swing producer, like someone who can just turn the taps on and off really fast.
Exactly. Saudi Arabia is the textbook example. They maintain a ton of spare capacity.
Right. So if a crisis removes global supply tomorrow, Saudi Arabia can just turn a valve, flood the market, and cash in on the price spike. Canada can't do that.
Canada simply cannot do that. The oil sands do not have that kind of elasticity. You can't just jumpstart a massive steam injection project overnight.
Right. So if you need a quick meal right now because you are starving, Saudi Arabia is the fast food drive-through.
That's a great way to look at it.
But Canada is more like a slow cooker. It takes a lot of prep time, you have to plug it in and wait, but it's going to feed you reliably for the rest of the week.
Yes. So Canada's true power isn't throwing more oil into the market this month. It's steadily growing market share over several years through these long-term contracts.
And building LNG plants and pipelines literally takes years, sometimes over a decade.
Exactly. So if you are a day trader looking to make a quick buck off a news notification, Canadian producers are the completely wrong vehicle for you.
So we really have to change our entire lens here. The core rule for the listener's future investments should be, like, never just look at the shiny new port on the British Columbia coast.
Right. BC is just the exit door.
The true headquarters of Canada's energy strategy is Alberta. That is the powerhouse making it all profitable.
Exactly. If the underlying equation in Alberta works,
Yeah.
and it is, then the pipelines and the coastal ports become incredibly secure investments.
I love that. To wrap up our deep dive today, I want to leave you with a final thought-provoking question to ponder. If massive global players like South Korea are actively restructuring their entire supply chains to prioritize slow but steady long-term security over overnight availability, how will that change the way we value other commodity producers in our own portfolios?
Yeah, that really forces you to reevaluate what kind of risk you're willing to hold.
Are you still paying a premium for the volatility of the drive-thru when the smartest money is quietly buying the slow cooker? Think about it. Well, that's all for today. Don't forget to subscribe and hit that like button.